The second one.
Oh, okay, second one. Okay, so let me read that. Last month, when Holidays Creation Incorporation sold 50,000 units, total sales were 200,000. 200,000. Also open my calculator as well. And the total variable cost is 120,000. So we have a CM, which is 200,000 minus 120, which is 80,000, right? So 80,000 divided by 200,000. Answer is 40%. So we have CM ratio 40%. Estimate the changes in company's net operating income if it were to increase its total sales by 1,000. Okay, so our CM is above our fixed expense. Yes, because CM is 80,000, which is above our fixed cost. So we can say that if sales are increased by 1,000, contribution margin will be increasing by 40%, and that will be contributing to the operating income. Anna, what do you want to confirm? I have pasted a solution here. You can check it out here. We have a 40% sales. 40% is the contribution margin ratio. Increase in sales multiplied by 40%, 400. If you want to verify this, here we go. So total sales going to be, and total sales price going to be, right? Price going to be 4 per unit. Increase in sales is 1,000. And if you don't, understand by this, then just compare this scenario. Sale is increased by $1,000. Variable increased by 1,2600, and you see at the end the changes in total operating income is just 400, which verifies our contribution margin concept. Ayana, you understand?
Yeah, I do. Thank
Who has different answer? Crystal, Jackie, Sunho,
Yeah,
Lance,
Sam.
Min.
I have no question.
I'm sorry. Can I ask just now? Except Landry, who is in my group? Because I want.
Excuse me.
So.
Hello. Crystal.
Okay, thank you.
Okay, you guys finished? I thought you were asking me some questions.
Yeah, it's all good now. Sorry.
Okay. Okay, let's move. Our fourth learning objective is show the effects on contribution margin of changes in variable cost, fixed cost, selling price, and volume. Let's talk about this. So here it gets a little bit more advanced and interesting as well. So how we calculated the variable expense ratio? Variable cost divided by sales is the variable expense ratio. So it can be computed by dividing variable expense by sales, or in a single product analysis, it can be computed by variable cost per unit divided by sales per unit. Right? So there are two methods to calculate variable cost ratio. Number one, total variable cost divided by total sales, or in per unit sense, per unit variable cost divided by per unit variable sales. Simple. And how we can, play with the changes in fixed cost and sales volume to see the profit. Here we go. What is the profit impact if RBC can increase its sales from 500 to 540 units by increasing advertising budgets 10,000? So would it be more profitable? In other way, would it be more profitable for a company to accept this kind of strategy? They have to spend monthly 10,000 and their sales increase by just 40 bikes. Let's talk about this. The sales increase from 500 to 540. We know that the price of one bicycle is 500 each, so we have 250,000 and 270,000. Since our fixed expense, which is budget, has increased, so we have now 90,000. And look at the magic here. Our sales increased by 20,000 here, but our profit is decreased by 2,000. And what is the reason? Even though our contribution margin has increased, even then we are having 2,000 decrease in net operating income. Why? Because of increase in fixed cost. So that's why every business is worried about its fixed cost, because the marketing department is pushing hard to sell more. The production department is pushing hard to make more goods, right? Even then, the profit is decreasing. You understand this miracle? So the shortcut is that if you don't want to do all these statements and you want to find out whether this is profitable or not, just see that how many units you are selling more above our above from previous one, 40, and how per unit is CM. This is 8,000. So 8,000 is going to net operating income. 40 multiplied by 200 is the per unit contribution margin. So it means the units you sold will bring out income of 8,000 while you are having expense on those 10,000. It means you are expensing 10,000 to bring back an income of 8,000 to the business, which is not profitable. That's why we are having a loss. So the impact of basically fixed cost is huge here in this case. And now let's talk about changes in variable cost and sales volume. So what is the profit impact if racing bicycle can use higher quality raw materials, thus increasing the variable cost by $10 per unit to generate an increase in sales from 500 to 80. So we can just solve right now here. How much is the variable cost? 300. Now it becomes 310. Previous sales were 500. Now it's 580. Right? What should be the profit? Can you calculate that? Here we go. So this is calculated as 310 multiplied by 580 units. And you see here, we just increased $10, which is also a huge amount in variable cost, right? Even though we did not increase our price, Sale price is still 500. Look at our profit. Increased by 10,200. This is a miracle, a positive miracle. Right? By changing our variable cost and sale volume, we can generate more than 50% profit. So that is the beauty of playing with the CVP analysis. And now let's talk about fixed cost and sale price and volume together. What is the profit impact if RBC cuts its selling price 20 per unit? It means now the sale price is going to be $480. Increase in its advertising budget 15,000. So it's now fixed costs will become 95,000. And its sales going to be increased by 150 units. Would this strategy be good strategy or bad strategy? Let's see. So we know that we are going to sell 650, price decreased by $20, so 480 multiplied by 650, answer is 312,000. Variable expense remains the same, 300 multiplied by 650, answer is 195,000. And then we have increased our fixed expense to 95,000. Look at the profit. Just increased by 2,000. Even though you managed to sell and your previous sales are considerably low than your current sales, look at the volume here. More than $62,000. Yes, $62,000 increase in sales, leading you to just $2,000 profit. You see the magic of having increased fixed cost? Your net profit will grow very, very slow. If you just maintain this 80,000 and you increase the variable cost, even then your profit skyrocketed.